Let's get a look at the markets now. And Monday brought quite the shock to the oil market when the May contract went into the negative. Now, this is the first time that's ever happened since oil futures started trading back in the early 1980s. There's been a slight recovery, but we are in unprecedented territory. Luke Beckman of Central Valley Ag joined me Wednesday morning to make sense of it all.
Troy, I think that the demand destruction over the last 60 days has been pretty well documented. Everybody knows what's going on. As it relates to crude oil, you really have to think of crude as having a finite storage capacity. It's not like corn, it's not like soybeans, wheat. Those commodities can be put in temporary storage, most often in piles just on the ground. Crude oil, we don't have that capability. And so essentially what happened in the crude oil market is it was a paper squeeze. Somebody was long paper oil coming into this week. And when you get into that situation, liquidity becomes a little bit of an issue because when you're in the delivery period, somebody has to have storage capacity somewhere to take delivery on that commodity. And, with May futures now expired for WTI crude, June takes the front month, and we can't rule out that could happen again, with June crude as well.
What are some things this instability means for the producers at home watching, and are there any impacts that this will have on their input decisions or their farm management decisions?
Well, we push, in excess of 5.4 billion bushels of corn every year into ethanol in the ethanol space, and corn, became an energy product in the 2000s as ethanol production ramped up. So it absolutely impacts, our farmers, and they know that as well. It's going to provide for some cheaper energy opportunities. We're really just seeing a reset in commodity prices and both corn and soybeans. And, that's going to impact input prices further down the line. From an input side, they're already seeing urea values reset, further out on the curve. So the whole marketplace just has to adjust down, with everything that's happening. And it'll happen from inputs all the way down to, the price of corn that producers receive at the elevator or the processing facility. So it's really something that, we've not seen before, and because of that, we don't know exactly how to act. We're making those decisions the best we can as we navigate through this.
All right, let's put a pin in oil for now and move on to issues with the supply chain. That's something we've been talking about on the show for the last few weeks. So pork plant closures, they've had the potential to throw a wrench in a lot of things. Now, new COVID infections, even at some Nebraska plants. Anything else that you're tracking producers should be aware of on that front?
Well, yeah, it goes back to, slaughter numbers and just looking at, some of the data out earlier this week, cattle slaughter down, 20 some percent year over year. We have, facilities up in Canada that are closing down, that represent a big share of cattle slaughter capacity. I got word of another Tyson plant in Iowa this morning that was shutting down for the same reasons. And so, you start to question, how's that going to impact feed demand, of course, on the corn balance sheet. It's pretty easy to see the impacts in soybean meal and DDG, over the last 30 days. And so a month ago, the USDA updated their balance sheet, and they acknowledged the ethanol problem. They cut 375 million bushels off the balance sheet right away. Applaud them for making that recognition. And feed demand was bumped, in large part because the stocks report at the end of March was, indicated that should happen. You're really going to question feed demand going forward for the rest of old crop. It's going to be really hard to quantify that, Troy. We're probably not going to get any really good insight into that until we see the stocks report at the end of June. But all of a sudden you've added, 500 to 600 million bushels of lost demand onto the 19 and 20 carryout. And for producers to quantify that in their minds, just think of it this way. For the corn crop they're planting right now, that's going to equate to 5 to 6 bushels to the acre nationally for this corn crop. So we have to shave 5 to 6 bushels per acre off of the crop we're growing right now just to get back to par, to pre-COVID levels. So a lot of crop issues would need to pop up to really make up for the lost demand and to get the balance sheet back to the point where we can support, futures around $4.
Yeah, a lot of work to be done. And finally, Luke, one more question. We'll let you go. Just curious as to a couple of the big questions you've been getting from folks over the last few weeks, and what's some of the main advice that you've been offering?
Right now, if a lot of producers are asking questions about what to do with old crop corn. Um, it was, as of right now, Wednesday, it was optimistic to see corn defend support from 2016 at 301 on the May futures, and we rebounded off of that. If we can confirm a reversal, we can start to plot retracement levels and where we should be sellers. Farmers need to lower their expectations in terms of what they can expect to sell their old crop grain for. And the other thing to watch is basis, Troy. Ethanol is running at 50% of capacity right now. And so every day we're losing demand. It's that grain's not going anywhere. Really get a little bit concerned about what basis would look like the last half of this summer. If everybody's delaying that marketing decision now because of, poor prices, it just kind of backs everything up. And if farmers want to, deplete their inventory to get ready for harvest this, late summer, there could be a lot of grain that needs to find a home, late summer. So I would not carry a lot of physical basis risk past the 4th of July this year. If you can see basis firm up, I think you need to lock that portion in and maybe price your futures independent of that. So that'd be an idea on old crop corn. I think new crop, if we can get these futures back into the 370s, we should have expanded carries this year with a big crop. Those should be opportunities for producers to be pulling the trigger. $4 feels like a long ways away, and we're going to need some major crop issues to get back there. Soybeans present a more diverse array of possibilities. Yield can have a lot to say about where the carryout ends up on soybeans. So, have your orders in on the beans. We can't rule anything out at this point, but $9 harvest cash is a ways away today, but I still think it's a possibility for a lot of people.